We don't start this briefing with headlines, we start with mechanics. When U.S. forces conducted strikes in Venezuela and captured President Nicolas Maduro, it didn't magically rewrite supply and demand for silver overnight. What changed was the flow risk premium embedded in preciously thin silver markets, and that's where the real move began. In the days after the strike and arrest, silver moved sharply higher alongside gold as traders positioned for uncertainty rather than fundamentals suddenly improving. The market didn't rally because industrial demand spiked or mine output collapsed. It reacted because uncertainty spiked, and capital rotated into perceived safe havens. This was not a normal supply-demand update. This was forced behavior from risk repricing. Traders who treated the move as just another breakout missed the deeper liquidity and risk drivers that pulled prices away from equilibrium. Today, we break down why silver felt like it was pulled out from under traders' feet, because the real forces at work are often invisible until you see them in the mechanics. In a minute, we'll expose the single technical zone that decides whether $200 silver becomes psychologically inevitable, and later, we'll tease the signal that blows this whole narrative apart if it fails to trigger. Markets don't rise because of headlines. They rise because mechanics on the ground get upended. What we're talking about wasn't a simple headline reaction. It was a repricing of risk at a systemic level. In the immediate aftermath of the U.S. military strikes in Venezuela and the capture of President Nicolas Maduro, markets didn't wait for fundamentals like industrial demand or mining output to update. They updated the perceived risk premium embedded in asset prices. Silver futures began rallying before any rational narrative about supply or demand could be written because the market first reacts to uncertainty, and uncertainty is a mechanical driver of price when liquidity is thin. Geopolitical risk flows directly into market structure. A sudden increase in perceived systemic risk pushes capital out of crowded risk assets and into stores of value. In this case, that meant a rotation out of equities and into precious metals, with silver being especially sensitive to shifts in sentiment because it often trades as a leveraged reflection of risk premium movements. At the same time, positioning ahead of the event was skewed. Many speculative books were long equities and short metals, and when fear hit, crowded positioning had to be unwound violently, creating outsized moves relative to the news itself. Silver's inherent liquidity profile, thinner and less deep than gold's, magnified those moves because there are simply fewer orders to absorb rapid shifts in demand. Crucially, this wasn't just paper futures moving in isolation. Flows spilled into cash markets, physical premiums widened, and delivery expectations shifted, all of which are mechanics, not narratives. This combination of repricing risk and forced position adjustments set the stage for the next part of our briefing, where we examine the liquidity choke points that made this reaction so large relative to the underlying fundamentals, and how the real difference between a sustained breakout and a fake-out washout lives in those microstructural dynamics. What made this move feel violent wasn't the size alone, it was the way it traveled through the market. Silver is structurally far less liquid than gold. Its order books are thinner, its depth is shallower, and under normal conditions, that doesn't matter much. Under stress, it matters a lot. When macro risk suddenly reprices, markets don't adjust smoothly. They jump between pockets of available liquidity, and in silver, those pockets are spaced far apart. So when selling or buying pressure arrives all at once, price doesn't negotiate, it relocates. As geopolitical risk spiked, risk assets broadly sold off, and margin desks across the system began demanding liquidity. That process forces participants to raise cash wherever they can, not where it's most logical. Silver positions, particularly leveraged paper positions, become funding sources. Positions are cut not because the thesis changed, but because balance sheets are being protected. Fact, silver's open interest compressed rapidly. Interpretation, traders weren't repositioning thoughtfully, they were being pushed out. That compression forces rapid repricing because fewer contracts remain to absorb incoming orders. At the same time, stop-loss clusters sitting near obvious technical levels were triggered almost simultaneously. Once those were hit, computerized selling and hedging systems layered on top of human liquidation. That convergence is what creates the sensation of the floor dropping out. Not a slow exit, a trapdoor. Importantly, the paper market moved first. Futures repriced ahead of physical premiums because futures are where forced behavior expresses itself fastest. But physical markets did begin to tighten as the move progressed, confirming that the stress wasn't purely speculative. Add to that the record institutional flows moving into gold, and silver was mechanically pulled along as a correlated monetary metal, amplifying what was already a fragile liquidity environment. This is why it felt disorderly. Not because value vanished, but because liquidity did. And as we move forward, the critical question becomes where these forced behaviors encounter structures strong enough to either absorb them or reverse them. In the next part, we'll start isolating the technical zones where that decision is likely being negotiated, before later contrasting what paper price is doing with what physical stress is actually signaling. Violence in price is not always violence in value. Its violence and liquidity. Fact, silver futures rose significantly after the geopolitical developments in Venezuela and the associated market reaction to heightened uncertainty, with notable gains in the precious metals complex alongside gold. Interpretation. Safe haven demand clearly contributed to that move, but safe haven demand on its own doesn't automatically cause a durable long-term trend change in price structure. It often reflects a momentary repricing of risk rather than a fundamental supply shock. Fact. Venezuela's formal silver production is limited on the global scale, so the country's internal crisis has a minimal direct impact on worldwide physical silver supply dynamics. Interpretation. Markets don't react to isolated facts. They react to perceptions of systemic instability that can cascade through risk premiums, and that S what triggers short-term repricing rather than changes in mining output. Fact. Real scarcity in precious metals is best measured through physical market indicators, dealer premiums, inventory levels, delivery notices, rather than through headlines alone. Interpretation. Headlines alter perception quickly, but mechanics shift price structure over time. The former can be fleeting, the latter can define structural paths. This framing matters because if we confuse narrative with mechanism, we risk misreading what's intrinsic versus what's a transient sentiment adjustment. The maps of risk lie not in what headlines tell you, but in what measurable on-the-ground indicators confirm about actual supply and demand pressures. In the next section, we'll define exactly which measurable indicators help distinguish real scarcity from temporary sentiment. And later, we all address how wrong interpretations can trap traders just ahead of the next decisive move. Facts anchor us. Interpretation navigates risk, but we never substitute one for the other. By this point in the briefing, the question stops being why silver moved and becomes where this movement is being tested. Markets negotiate risk through structure, and structure shows up as zones rather than single prices. On the upside, there's a high probability resistance cluster where prior distribution occurred and where momentum must either prove itself or fail. This is the region where short-term traders historically defended exposure, where volatility expanded, and where the last wave of sellers previously found enough demand to halt declines. When price returns to such an area under stress, it becomes a decision zone. If participation expands there, if volume builds instead of fades, that suggests acceptance. If activity contracts and price hesitates, that suggests the market is not yet willing to pay higher risk premiums. Below, there is a corresponding support cluster where forced selling previously exhausted itself. This is not a comfort level, it is a memory. It marks where margin pressure, stop runs, and liquidation cascades slowed because enough bids finally emerged. Behavior here matters more than the number printed on the screen. Expanding volume on a break below support often signals another forced leg. Drawing volume on a retest often signals sellers are running out. Liquidity gaps around round psychological levels intensify this process. Markets tend to accelerate through those numbers because order books thin out and stops cluster. That is why moves often feel sudden near them. Next, we move from paper structure to physical stress. Structure also disciplines indicators. Bullish divergence only matters if price can reclaim and hold above the upper decision zone. Without that, it remains a potential, not a condition. And structure cuts both ways. Stops below support clusters can trigger washouts. Trade above resistance increases follow-through probability. The market respects structure over short-term emotional empty narratives. Up to this point, we've been talking about futures behavior, risk premiums, and liquidity mechanics. That's necessary because paper markets move first. But paper is not where scarcity lives. Scarcity shows itself in the physical layer, and that layer speaks in different signals. Physical premiums at major dealers are one of the earliest tells. When those premiums begin to rise while spot prices are already elevated, it suggests that demand is no longer purely speculative. It suggests that actual metal is being pulled through the system, and that the paper price is struggling to source real supply fast enough. Inventory levels inside major reporting hubs like COMEX and the LBMA matter for the same reason. Those warehouses represent the pool of metal that can realistically be mobilized into delivery. When listed inventories stagnate or begin to draw while futures activity accelerates, that creates tension. Delivery notices and warehouse withdrawals are not opinions. They are quantifiable stress metrics. They tell you whether contracts are being rolled, closed, or actually demanded for metal. Silver's industrial role sharpens this distinction. Unlike gold, a meaningful portion of silver demand is consumptive. Once it leaves inventory, it does not quietly return. That means physical tightness is not only a monetary story, it is also a logistical one. Rising premiums paired with flat or declining inventories increase the probability that price is compensating for real-world friction rather than just speculative enthusiasm. Watch for slippage between paper prices and physical pricing. When futures surge but physical premiums refuse to follow, moves often fade. When premiums rise faster than futures, volatility usually follows. That divergence is often where the next leg is born. The next phase follows. From here, the market no longer moves as a single narrative. It separates into conditional paths, each defined not by opinion, but by behavior. Scenario planning is not prediction. It is preparation for how mechanics tend to resolve once a decision zone is engaged. The first path is a bullish breakout scenario. This develops only if price can sustain acceptance above the upper resistance cluster we discussed earlier. Not spike above it, not briefly trade through it, but hold above it while participation expands. The confirming conditions are mechanical. Volume should build on advances rather than dry up. Physical premiums should tighten instead of relaxing. Delivery notices should begin to increase rather than roll forward quietly. If those elements align, it suggests that higher prices are being required to source metal, not merely to excite traders. In that environment, momentum often feeds on itself. Risk premiums expand. Capital begins to pursue scarce physical exposure rather than leveraged paper expression. Not because of optimism, but because the system is signaling that access is becoming more expensive. The second path is the fake-out scenario. This emerges when price approaches or marginally exceeds resistance, but participation fails to follow. Volume fades. Open interest stagnates or contracts without stress. Physical premiums remain flat or soften. Delivery demand stays muted. In that case, the move has done its job emotionally without doing it structurally. It has attracted attention without changing conditions. The typical outcome here is not collapse, but digestion. A pullback into the range, frustration, chop. The structure remains intact, but direction remains unresolved until a new catalyst forces repricing. The third path is the washout then higher scenario. This is the one most people miss because it feels wrong when it is happening. Here, forced selling resumes, stops below the support cluster are triggered. Price undercuts levels that looked solid. Paper positioning is flushed. Yet beneath that surface weakness, physical conditions do not ease. Premiums remain elevated. Inventory outflows continue. Delivery pressure does not disappear. If those signals persist, while price is being driven lower by liquidation rather than new selling, it often marks capitulation rather than failure. Liquidity is being cleared, not value. When that process exhausts itself, rebounds tend to be sharp because the structural tension was never resolved. None of these are forecasts. They are frameworks. Each has observable triggers. Each has invalidations. And each exists so that when the market chooses, you are reading behavior rather than reacting to noise. Next, we shift from mapping outcomes to controlling exposure because risk discipline is what keeps you solvent across all three. Scenario planning isn't prediction, it's preparedness. Once scenarios are on the table, the conversation has to shift from what the market might do to how you relate to it. This is where most participants quietly fail. They reduce a conditional environment into a binary one. Up or down, right or wrong. That framing doesn't survive volatility. Markets of this nature require non-binary thinking. Conditional positioning, exposure that can be adjusted, not defended. Risk discipline starts with accepting that no scenario deserves full commitment before it earns it. That means working in zones rather than absolutes, scaling into areas where structure is being tested instead of chasing motion after it's already happened, scaling out into extensions rather than waiting for emotional certainty that never arrives. This is not about clever entries. It is about controlling the emotional temperature of your positioning so that volatility does not dictate behavior. Margin discipline sits underneath all of this. Silver does not move politely when liquidity thins. If exposure is sized in a way that forces reaction instead of allowing observation, then mechanics will make decisions for you. Volatility management is not an abstract concept here. It is the difference between being able to hold through noise and being pushed out by it. Time framing matters just as much. These environments rarely resolve in hours. They develop over windows. The next 14 to 28 days matter more than the next 14 minutes. When attention compresses too tightly, every fluctuation feels like information. Most of it isn't. Avoid chasing moves. Measure them. Let price come back to structure. Let behavior confirm condition. And remember that discipline is not passive. It is active restraint. It is the ongoing refusal to let urgency replace process. Stay with us, because what ultimately decides which scenario is gaining probability will not be opinion, but the specific signals beginning to emerge across both real-world and paper markets. Discipline is the margin between fear and profit. As this structure develops, clarity doesn't come from watching the price tick by tick. It comes from tracking a small set of measurable signals that reveal whether stress is building or dissipating beneath the surface. Physical premiums should be watched daily. Dealer spreads are one of the fastest ways to see whether real-world demand is absorbing metal or whether paper enthusiasm is running ahead of itself. Rising premiums while price holds suggest tightening conditions. Falling premiums while price rises often suggest speculation outrunning reality. On a weekly rhythm, inventory reports from major hubs like COMEX and the LBMA deserve attention. These numbers don't forecast price, but they do map the availability of deliverable supply. Stagnant or declining inventories during elevated futures activity increase the probability that price is compensating for friction. Rising inventories tend to signal relief. Delivery tallies and notice dates add another layer. They show whether contracts are being rolled forward quietly or whether participants are increasingly standing for metal. That distinction matters more than volume headlines because it reflects commitment, not interest. Open interest shifts at the key zones we discussed earlier help contextualize all of this. Expansion with price acceptance suggests new participation. Compression under stress suggests liquidation. Neither is bullish or bearish on its own, but each defines the phase the market is in. Correlations matter as well. Silver rarely acts alone. Alignment or divergence from gold's trend and US dollar behavior often clarifies whether moves are monetary, speculative, or liquidity-driven. Policy catalysts, rate expectations, and central bank signaling will continue to act as volatility accelerants rather than causes. The next 14 to 28 days form the immediate decision window. This is where many of these signals either align or contradict one another. In the close, we'll ask you two questions that connect these indicators directly to how you reading the tension developing. Signals don't shout, they whisper until you miss them. At this stage of the briefing, the most valuable input is no longer mine, it's yours, because how you interpret these mechanics shapes how you prepare. Which scenario do you believe the market is currently pricing? A sustained breakout, a frustrating fakeout, or a washout meant to clear positioning before another attempt higher? More importantly, what mechanical evidence are you using to support that view? And which physical signal matters most to you when deciding whether pressure is real or temporary? Is it dealer premiums, reported inventories, or delivery behavior as notice periods approach? Those choices reveal more about this market than any single candle ever will. If you want calm, measured briefings when volatility rises, consider subscribing. This channel isn't built on excitement. It's built on observation. We measure, we don't gamble. As you think through your answers, hold this unresolved tension. If policy expectations shift or another geopolitical shock enters thin liquidity while price is stabilizing, the next major leg could form faster than the last. Your edge comes from understanding structure, not headlines, always going forward.